Hey, it's Tom here and welcome back to the channel. So in this video I want to cover some updates on two particular companies that I follow pretty closely. The first one being Seritage Growth Properties. So Seritage is a REIT, a real estate investment trust over in the US. It's a company that I've covered in a couple of different live streams now with Brad Kellner from the Stock Compounder Brad Kellner YouTube channel. It's a company that initially got on my radar after seeing Mohnish Pabrai invest in it, and they recently put out their second quarter 2021 earnings. So I just want to walk through some of the key takeaways that I got from that earnings release. And the other thing I want to cover in this video is a recent rumor that's kind of going around about a potential buyout of the A2 milk company by Nestle, which shot the stock up about 11% just in one day yesterday. It will have probably traded again by the time this video comes out, but nonetheless very interesting news for a rather large company here in New Zealand. So that's topic for today's video. Before we get into that, we do have a sponsor for this one, and today's sponsor is Hatch. Now, Hatch have been my personal broker of choice for me as a New Zealander looking to buy shares in the US for over a couple of years at this point. I initially switched across to Hatch basically just to save money on fees. I was paying $90 US a trade with one of the banks here in New Zealand for trades that I can now do for $3 US in Hatch. So I've been a massive money saver in terms of fees and have continued to improve the platform kind of right along the way. And they've also been doing their bit to educate newer investors into the share market as well and answer some of the more popular questions that they get from their customers. So earlier this year, they released new features like kids accounts, which is an account you can set up for your kids with even lower fees than traditional Hatch accounts. And just in the last couple of weeks, they hosted the great debate on property versus shares, which is clearly a hot topic, particularly here in New Zealand. So I'm a big fan of what Hatch are doing and have been a customer of them for more than a couple of years now, like I say, and they've been a long-time sponsor of the channel, and I'm more than happy to continue getting behind what Hatch are doing. So if you're interested in checking out Hatch, you'll need to go to the link hatch.as/investingwithtom. If you go to that link and start a new Hatch account and deposit 100 New Zealand dollars into that account, you'll get a free $20 top up so that you can get started investing with a little bit more money. Okay, so let's kick it off here with the recent update out of Seritage. Firstly, just a quick kind of recap of, I guess, the investment thesis from my perspective. So this came on my radar initially after Mohnish Pabrai having invested in it during the first or second quarter of 2020. He bought it as the stock went from $40 or $50 a share all the way down to $5, and at a guess, I think his cost basis is probably a little bit below, somewhere in the kind of $5 to $10 per share range, I would say. So he's experienced roughly a double on the stock. It's around $15 or so today. And this is basically the investment thesis from my perspective. So Seritage does not have very good cash flows right now. They're kind of going through this redevelopment phase of taking some of their existing properties, the vast majority of which used to be basically Sears stores. So Sears have now gone bankrupt. That's where Seritage initially actually came from, as they were spun out of Sears pre-bankruptcy. And they have a whole bunch of properties that are either empty or renting for very cheap rates, sort of $4 or $5 per square foot. And Seritage are kind of going through the process of selling some of those assets off where they don't think they're sort of attractive from a redevelopment point of view. And the assets that they do keep, they're redeveloping and then renting out at more like $20 per square foot. So you're getting sort of this big re-rate in the rental income. And also some of their key locations, so their Dallas property, for example, they're going through quite a big sort of densification program. So building vertically to try and increase the square footage that they can actually rent. With the Dallas property, for example, that's currently a 200,000 or 300,000 square foot, previously Sears store. The goal of that big development is to try get it to closer to 2 million square feet. So about a 10x in sort of the square footage, and also presumably about a 4x in the rent per square foot. So when you combine a 10x and a 4x, you suddenly get a 40x in rental income, which is very significant, clearly. So that's kind of the investment thesis. Like I say, the cash flows are not good at the moment, and that kind of continued in this recent earnings release, which I'll get to in a sec. But the sort of net asset value is very strong, and in some of the previous live streams that I did with Brad, Brad kind of got to sort of a liquidation value type assessment of Seritage of somewhere in the $30 a share range. So if you're able to buy shares at $5 or $10 like most provided, or even say $15 today, that's how we were kind of viewing the margin of safety in this investment. So it's not a recommendation to go out there and buy it or anything like that, but that's basically the overview in terms of what's happening at Seritage. Now, it's worth noting that Seritage do also have some debt, so they have about a $1.6 billion loan from Warren Buffett's Berkshire Hathaway. They have capacity to push that to $2 billion if they meet certain net operating income targets. They also have about $70 million of preferred stock outstanding, so if you search Seritage on Yahoo Finance or something, you'll actually see two kind of securities that trade. So you have the regular Seritage Class A shares, I think they're called, and you also have the preferred stock, which obviously won't capture as much of the upside of Seritage. Does work out well, but they pay about a 7% dividend on the sort of price at which those shares were issued initially. So that's kind of what's going on with SRG. We also had a CEO transition earlier this year from Benjamin Shaw, who kind of went on to bigger and better things and got a brand new larger pay packet at a much larger real estate investment trust. And we had Andrea Olshan come in, and this is in fact her first sort of full quarter at the helm. So first quarter of results where she was basically there for the entire time. And if you want the summary of this kind of entire earnings report in a couple of sentences, it's basically this. It is essentially that Seritage in the short term or right now still continues to have very negative cash flow. So they're still burning cash. They really have a lot of empty properties and a lot of properties that are either going to be sold or redeveloped that really aren't producing any cash flow right now, and that kind of continues, and I think will continue for probably the next couple of years, I would guess. But they are making good progress in terms of their redevelopments and trying to get to a cash flow positive point, which if you're an investor in Seritage, that's obviously where you want these guys to end up. So they gave this example of one of their first major developments that is going to be open probably in the next 24 months. And really the case with Seritage, I think a lot of investors see it that there's really sort of a handful of properties that will probably create most of the value for shareholders of Seritage. So they gave an example of that in their sort of redevelopment activity update. And they said the company is anticipating that its first large-scale redevelopment will open in the fourth quarter of 2021 in San Diego, California, followed by its Aventura, Miami, Florida location in the fourth quarter of 2022. As the grand opening of San Diego, California nears, the company is looking to activate the second phase of this project, which is programmed for a large-scale office/life sciences and residential development. So it's good to see that kind of progressing, like with the Dallas property I mentioned earlier, that's really not scheduled to come online till even after this, till sort of 2023 or so. The first phase of that will come online. And they also mentioned quite a number of smaller developments. So Seritage owns a little over 170 properties in total, and they said that the company has 30 projects active with a remaining spend of approximately $250 million to be invested over the next 24 months, which is expected to bring on 40 to 45 million of net operating income. So this is where things start to get really interesting. So one of the more common ways of valuing real estate, probably the most common way of valuing real estate, commercial real estate particularly, is to basically look at the net operating income, kind of the earnings essentially that have been generated from the rental properties, and then apply sort of a multiple to that, or a cap rate in the case of real estate. So typically commercial properties are being sold in the US right now in the sort of areas that Seritage operates in for about a 6 cap. So on the price you pay, you're generally getting about 6% of your money back in net operating income. So if you kind of work backwards off that 40 to 45 million, let's go with just the low end and call it 40 million for those 30 projects Seritage we're talking about over the next 24 months. If you apply a 6 cap to that, so take your 40 million and divide it by 6% or 0.06, you land on a property value of about $660 million just from those 30 properties. And keep in mind, Seritage has over 170 properties, and they have a lot more net operating income hopefully to come online after this development that they're talking about on the next 24 months. So if you assume that's worth $660 million just from those 30 properties, and then compare that to the current market cap for Seritage, The current market cap is about $670 million. So you're more or less covering that current market cap just with these 30 properties that are coming online in the next year or two. Now, of course, Seritage has some debt, and there's other things to kind of keep in mind with what they do with the rest of the properties and kind of the cash burn between now and getting these properties online and so on. But hopefully that just kind of gives you a feel for where Seritage are at with their redevelopment process and the potential value that can be created for SRG shareholders. Now, the other thing I have been following quite closely with SRG, and this will be kind of the final thing I'll say on this topic, and then we'll get on to A2M.AX, is just kind of following what they're doing with their rent per square foot kind of rates. So some areas of commercial property have certainly been beaten up over the last year or two. Office is a very, very good example of that. And retail, I think a lot of people have kind of a longer term, quite negative view on that space. So it's interesting just to follow what they're doing with the rents, because that is a big part of the thesis with SRG, is going from $4 or $5 a square foot to more like $20 a square foot. And it's just been interesting to kind of follow along with where they're actually signing up new leases and what kind of prices they're getting. So this is sort of a summary of what they call their SNO leases, which is signed but not opened. So they haven't quite sort of moved into the new properties and so on, but the leases that they've kind of just signed up most recently. And this is kind of where those are at the moment. So they basically had 83 of these signed not open leases right now. Average rent per square foot of not quite $24 per square foot. So certainly right on target, and exceeding even that $20 per square foot number that I mentioned earlier on. And that rent that they can bring in the door obviously will have a big, big impact on the eventual valuation of Seritage once they're kind of fully through this redevelopment phase. Okay, so let's talk a little bit about the A2M.AX company. Now, the A2M.AX company is one that I've been covering for a couple of years or so now, actually, on the channel. I first made a video on the A2M.AX company when it was $14 or $15 a share or something, and I sort of said, the business looks pretty interesting, the financials are near perfect, like phenomenal growth, very steady, compounded growth for a long time at that point, but I just felt the price was kind of too high. Like I said, it was about $15 a share at that point, and I sort of just passed on it back then. In the last 12 months or so, they've had a very rough year. So they've had back to back to back to back. I think it's literally 4 in a row. Earnings downgrades, and the stock has just absolutely tanked. I think it peaked out at about $20 per share or so, and peak to trough was down more than 70%. I think it got down into the $5 range for a short period of time there. So as that process kind of happened, I did actually make a small position in A2. It's nothing super meaningful, and certainly a lot smaller than my Seritage position, which we just talked about earlier. But I do have a small position in A2M.AX. I actually bought my first lot of shares at about $10 per share, and basically doubled that position at about $6 per share. So it's one I'm following. Like I say, not a huge percentage of the pie, but certainly one I'm following quite closely. And we had some interesting news come out just yesterday. So I started seeing things on Twitter about A2M.AX being up a lot, and I kind of was wondering what was going on. It was up about 11% on the day, which is a pretty sizable move. And it turns out that there has been an article come out of the Australian, which is a very original title for a news company. And they're basically saying that there's rumours that Nestle, of all businesses, are kind of sniffing around with A2M.AX and are potentially looking to acquire the business. So that's about really the extent of the story right now, to be honest. There's no really confirmed details or anything. I think A2M.AX has been looked at by overseas buyers in the past, but it's interesting to see someone as big as Nestle come along. One of the big sentiments that's been kind of floating around with A2M.AX in the last year or so is this idea of increasing competition in this kind of A2M.AX space and in infant formulas and so on in general. And Nestle are actually one of the big players kind of in that space. So to see them come in and say, maybe we don't want to compete with A2, maybe we're better off just buying them, is kind of something that's really interesting to see from an A2M.AX shareholder's perspective, being myself. And it goes on to say in this article that the market cap of A2, again, peak to trough, has fallen from about 16 billion, I believe that's New Zealand dollars, to under 5 billion New Zealand dollars today. So it's down significantly, and if you're a long-term investor and a long-term focused business like Nestle is, potentially it is a good time to, look at acquiring something like the A2 Milk Company. So it will be really interesting to see how this one plays out. The article goes on to say, the only other thing the article goes on to say really is that if a buyout was to happen, it would not happen until after A2 Milk's annual results are released, and that is only about a week or two away now. So it'll be an interesting one to follow. As an investor, I've actually never experienced one of the companies that I own being bought out, but I've seen other companies have this kind of happen, and I've certainly read several investment cases of companies being bought out, and it's a really interesting one to kind of work through. On one hand, you have this great potentially short-term pop and short-term, premium that you get paid for your shares by a buyer like Nestle, which is fantastic for, I guess, shorter-term investors. But on the other hand, if A2 Milk does sort of go through a recovery phase, which I'm of the opinion that they will, but there's various opinions out there, and probably most of them are quite negative at the moment, as you can tell by the share price. But if A2 Milk does go through this sort of recovery, potentially you're missing out on a lot of the longer term cash flows from the business if A2 Milk can be bought by Nestle at kind of a beaten up price compared to what it's been at in the past. So there's an update from me on both Seritage and the A2 Milk Company. Both of them are pretty fascinating stories to follow and companies to follow, and they're both companies that I have investments in, so I will continue to follow them very closely. So that's it from me for this one. If you're interested in the Hatch offer, you'll need to go to the link hatch.as/investingwithtom. But like I say, that's it from me, and I will see you in the next video. Cheers.